Goldman Sachs thinks that only an exogenous shock will likely cause a US recession in 2024. Otherwise, Goldman is sticking with its call that there's just a 15% chance of a contraction in the US economy next year. Well, my next guest thinks otherwise and says there are too many indicators pointing to a hard landing. He thinks that gold is at an inflection point, and that view may be shared by billionaire David Einhorn. Einhorn's Greenlight Capital has just increased its gold position to its highest level ever. Well, Tavi Costa says more funds are likely to follow that trend. Tavi is a partner and macro strategist at Crescat Capital, which has over $350 of assets under management. Tavi, very good to have you back with us.
Thanks for having me. Looking forward to this.
All right, Tavi, you make a very compelling case as to why funds and wealth advisors are under allocated to gold and are going to increase their allocation to gold. You also point out that central banks, even though there's been record gold purchases in 2022 and 2023, is also on track for record purchases according to the World Gold Council, are also going to increase their allocation to gold, and that ultimately you believe that gold is at an inflection point. Now, Tavi, we have heard all of this before, so I do want you to break down your thesis here and why this time it's different. But before we do that, let's start off with a big picture and let's get your macro outlook, because you see a hard landing coming in 2024 and you say that there are several indicators that confirm that. So break that down for us.
That's right. I think there's a profusion of macro indicators leading up to the belief that a hard landing is much more likely than a soft one. In fact, oftentimes soft landing narrative becomes more prominent right before we see a hard landing. This happens also prior recessions as well. And this is happening again today. But the profusion of macro indicators is quite profound, and there's quite a lot of those. Yield curve inversions, let's start with that one. We've had one of the most deeply inverted yield curve in the US, treasury curves that we've seen in history. And now with the steepening of that coming out of those inversions, it is one of those classic signs that you tend to see in credit markets where recessions tend to follow. The second one you can see here on the screen, actually, which we're looking at unemployment rates. Unemployment rates, actually, when they cross their 24-month moving average or 2-year moving average, every time that happened throughout history, we've had actually a beginning of a deterioration in labor markets. Something that hasn't really happened here is that the labor markets has been holding up quite well. One thing is to raise interest rates in an environment where labor markets are doing quite well. Another thing is to tighten monetary conditions when the economy is starting to turn. I want to point out to something else that I think it's very relevant, which has to do with the potential for earnings recession. In this chart, you can see that we've been kind of through a 70-year channel, upper channel of corporate earnings. And it is quite cyclical. So you hit the upper band of that channel, and then you see a recession, and then you see a bottom of that. That's when the cycle begins again. Right now, we're at a critical juncture for the S&P 500 earnings. And I believe that with deglobalization, labor costs, material costs, all sorts of things starting to squeeze the margins of companies, we're likely to see those earnings begin to actually drop. And so all that is giving me a very high conviction that a hard landing is much more likely than a soft one. And pay attention to market leadership, lastly. What's happening right now with it's not even the technology sector. It's really a few companies that are holding up the market. This reminds me of the tech bubble when 7 sectors in the S&P 500, one sector was up 60%, technology, all the others were down. And this is very similar to those periods. Russell 2000, small caps are down significantly. We know micro caps are down significantly. Year to date, even equal weighted index of the S&P is not doing quite as well as NASDAQ. And so there is certainly there are pockets of the market, very large pockets of the market already showing issues. And I believe that's investors should be very cautious about those imbalances right now.
All right, so what does this hard landing look like? Paint that picture for us. What does that mean in terms of the economy? What does that mean in terms of what we can expect from US equity markets? What does it mean in terms of the housing sector? What factors do you have on hand to help illustrate what this hard landing that you're expecting actually looks like?
Well, I think to begin with, you really need to understand the two largest pool of capitals that we have in the world right now, which is conventional investment strategies, the even pension funds, or you can talk about mutual funds or 401k plans and all those types of investment strategies. On the other side, you have central banks. Those are the real institutions in aggregate that really move the markets. We've seen in the last 30 years a very large focus in equities and fixed income allocation. In fact, that was what coined the idea of 60-40 portfolios. In this chart, for instance, you're just looking at one thing, one aspect of all a potential hard landing and how things can shift, which has been the case where a 60-40 portfolio today is as expensive as it was before the peak of the tech bubble or right before the Great Depression in 1929 or the panic of 1901. Basically, you're just looking at what is the yield provided by those 60-40 portfolios in an environment like today. That is despite the destruction of fixed income markets that we've seen recently with yields actually rising. The second pool of capital that is also another reason why I think a lot of things are going to shift is what's happening with central banks. This is the first time in 50 years that we're seeing gold actually have a better volatility profile than treasuries, meaning treasuries are actually more volatile than gold for the first time in 45 years. That's what this chart is showing you essentially. So those 60-40 portfolios that are looking for a defensive part of their allocation that currently is 40% into fixed income are likely to start deploying some capital into gold. And so that is one part that is shifting. The second shift is happening across central banks. And I think most people have somewhat covered that in your channel already. But central banks have started to buy gold, as we all know. But more importantly, those folks or those institutions, those sovereign institutions, they used to own about 75% of gold relative to their foreign reserves. Their objectives as investors is very different than the 60-40 portfolios. Their objective is to find something that is neutral with centuries of credibility to enhance the quality of their international reserves. And so today, gold is about 20% of their allocation in their central bank and their assets. And I believe that we're seeing the process of those institutions is starting to accumulate the metal in order to improve the stability of their monetary systems. And so as we see that happening more and more, it is hard to believe that it's not going to drive the metal a lot higher. So
Right.
So those are the important aspects of capital dynamics that will likely drive gold a lot higher.
Right. Before we break down your thesis into gold, although you've really touched on it quite extensively already, I want to get more of your outlook on a recession here, because again, people have been calling for a market correction on this show. People have been calling for a recession on this show for the past year or so, and we haven't had that. We have Goldman Sachs saying that it sees a 15% chance of a contraction next year. As inflation continues to decline, they say, and interest rate hikes have only had a modest impact on labor so far. According to Jan Hatzius, who's the chief economist there, he thinks that that is an average level of risk. We've had a recession approximately once every 7 years in the post-war period, and that gives you a 15% chance. And that 15% chance is mostly exogenous shocks, meaning an external factor. One such shock would be a geopolitical event, including an acceleration in the Israel-Hamas war, which could reverberate throughout global energy markets. So what do you make of that? That you've got the likes of Goldman Sachs saying, unless we have an external shock, and that's like a big geopolitical escalation, and they go on to why that would cause a recession potentially, only a 15% chance. And perhaps you can link that with the idea that we've had traditionally increased calls for a soft landing right before we've had hard landings.
Look, I think the fact that Goldman Sachs is calling for no recession is maybe the most bearish news I've heard in a while. But with that aside, I mean, just follow what the central banks are doing right now. They are a proxy for liquidity in the markets. That's the red line you're looking at this chart. Central bank assets contracting while the equity markets are still rising here. And I don't think you need to be a perfect market timer necessarily. All you need to do is avoid bubbles, avoid speculative environments. And why buy a FANG stock trading at a 50, 100 times earnings when you can buy, let's just say, a Brazilian bank trading for single digits or 3, 4 times earnings, a very established company, been in business for over 30 years, one of the most profitable business models we know. And so I think there's plenty other reasons to be deploying capital in other places
Right.
outside of technology.
But Tavi, help us with this, showing us that chart that you have, how traditionally calls for a soft landing, especially from establishment players, have actually preceded a hard landing. Because you're saying that Goldman Sachs saying a 15% chance of a contraction next year is a very bearish signal. Let's play that out with the chart that you have there.
Well, I just think that banks in general, they have their general views about the markets that are rarely right. And you just want to fade most of those news most of the times. The chart here is just showing you the incredible correlation between when central banks, some people, technicality of printing money or expanding their balance sheets tend to help risk assets like equity markets. And this is why the red line follows the white line. The white line is equity markets in the US. But, all the way back to 2022 or so, central banks have been contracting the size of the balance sheets. And we've seen close to $6 trillion coming out of those central bank assets already. And there's not much of a liquidity support for equity markets moving forward. And keep in mind, also raising rates, in which, if we go back to normal eras in markets, when cost of capital rises, you're supposed to be discounting a business, a present value much lower. So I don't really understand this whole euphoria regarding technology businesses and other companies. CAPE ratio in the US is at about 30 times. At other inflationary eras that we've had, 1910s, 1940s, and 1970s, the CAPE ratio was at 15 or 17 times. And all those times, the average compression of the multiple was close to 50%. So where are we going to go from here? What is the upside in the equity markets in the US? I don't really see the point. In fact, we all know the lagging effect of tightening monetary conditions. And when the Fed starts tightening or raising interest rates, it takes 1 or 2 years until that really starts to impact the system. And so, the fact that we're changing our views now because a year later after tightening, the market hasn't really started to decline, to me, it seems ludicrous. And on top of it, we all know what the yield curve inversion as a signal does. I mean, for sakes, we've had a 12 months straight of ISM manufacturing below 50 level. That every time we've seen this in history also coincided with a recession too. So, I think there's, like I said, a profusion of those indicators that gives us the conviction that a hard landing scenario is much more likely than a soft one.
Yeah, and one of those indicators, as I mentioned, is that chart you have. That's so fascinating to me, how calls for a soft landing increase following a hard landing. Just goes to show how the consensus view is often, well, not accurate, to put it mildly. Let's talk about the Fed, because along with the outlook on the economy, the Goldman Sachs note put a call at what they expect from the Fed, and they see the Fed waiting until the fourth quarter of 2024 before cutting rates. What do you make of that? Do you expect that sooner? Is that in line with what you think?
Well, I don't think the Fed will be cutting rates as soon as a lot of people do. I'm actually in the camp of a stagflationary environment, very similar to what we saw in 1973, 74. Yes, I am aware that the debt problem today is much worse than back then. I do think that the environment today is actually resembles a lot more how the market behavior looks a lot more like what we're seeing in the 70s, with yields rising and equity markets being a little challenged. I think we're yet to see equity markets having more issues, but I don't, in my view, inflation through waves. And I don't think this problem that we've had with the rise of consumer prices is going away anytime soon. Therefore, it's hard to believe that the Fed is going to be able to just put aside their mandate of actually finding price stability, which I think it's also ludicrous. But nonetheless, I don't think rates are going to fall as much as other people do, and I think that's what's been boosting equity markets a lot higher. I actually think the rates higher for longer became quite crowded recently, but I believe it's probably the right call. I don't think interest rates are going to fall much from here. Man, just think about what's happening with the Treasury market. How much issuances we're going to see in 2024 are going to be insane. I put out a check the other day. $8 trillion of treasuries, or 1/3 of treasuries, are going to be issued in 2024. Who's buying that? I do think that that's what's going to be pushing yields a lot higher, and why I believe hard assets is a much better proposition, value and macro wise, to be deploying capital into commodities and other commodity producers. And remember, just one last thing: when you are in an inflationary era, you really want to focus on owning businesses that have pricing power, and commodity producers have a inherent pricing power in their business model, because during those times you see commodity prices rising and they are able to make more money. Yes, cost rises as well, but the commodity prices actually tends to surpass the cost of producing that for a certain period, and therefore why you see those things or those businesses really doing very well. Along with resource-rich economies. So I think it's a much better way to focus on those parts of the market as an opportunity than equity markets in the US that are absurdly expensive, and to me just doesn't deserve any attention when it comes to investing.
Right. I certainly want to get your calls on emerging markets, particularly Brazil. But it's interesting that you mentioned that commodity-linked companies have more pricing power. That assumes, Tavi, that the demand is still there, because in a recession, one would think that there's less demand and therefore that pricing power may be impacted.
Yeah, technical recession of a deflationary environment like we saw in '08, certainly I would agree with you. But then look back in the '70s, how that played out. It wasn't like that at all. Hard assets actually appreciated as a defensive asset relative to other stocks and bonds. It was a brutal 1973-74. Just use that as a model. It was a brutal recession. It was one of the worst ways that you could hide as an investor that we've seen in history. And I think that there's something here very similar sort of playing out. The reason why we haven't seen a recession, in my opinion, has a lot to do with the fact that a lot of the institutions, sovereign institutions, corporations, households, have not yet reissued or their debt. In other words, there's a lot of debt that's going to be coming due in the next 12 months or so that are actually going to start increasing effective interest rates. So you're seeing interest rates rise, but effective interest rates is still very low relative to history. And so take mortgage rates, effective interest rates are one of the lowest levels in history, or even corporate bond yields are still very low relative to history. But that is yet to change. And I think that that's going to be what creates more bankruptcies and other problems in the credit market that is likely to then lead to more of a hard landing scenario.
Yeah, those rising interest rates, or even interest rates where they are with rising amounts of debt, does not bode well for the economy. And someone sharing your concern regarding the health of the US economy and then financial market is David Einhorn, it appears. David Einhorn, who of Greenlight Capital, he's looking to build a solid safe haven position in gold. The hedge fund there actually accruing its highest position of gold on record. And I'll remind our viewers that Greenlight is famous for successfully shorting Lehman Brothers in the run-up to the 2008 crash. Well, it now has a bigger stake in the SPDR Gold Trust, the spider there, than at any other point. The firm's third quarter 13F filings indicate that that position has increased by a whopping 89.2%. In the grand scheme of things, considering the AUM of the company, it's not such a big chunk, but this is still Greenlight Capital's biggest stake in gold on record. And that's just what we know in terms of the ETF holdings, because we know that the hedge fund also holds a significant amount of physical gold, which was not part of this 13F filing. So, Tavi, what do you make of this? That we're seeing hedge funds increase their allocation to gold. Is this a trend you expect to continue?
Yes, I mean, what a sharp move in my view, and also I should point out, the 71% of financial allocators or advisors have recently responded to a survey that they own less than 1% of gold, between 0 to 1% of gold. 70% of them own that. So, they barely own the metal. I cannot recall a time in history when advisors and in general investors have neglected owning gold for so long. And keep in mind what I said about central banks. They now own 20% of gold relative to their foreign reserves. What if we see a double from here? What does that mean in terms of capital inflows here? But the list of macro reasons to own the metal right now are larger than any other time in history. And this chart you're looking at the screen, it's really breaking down two cycles we've had for gold in the past, the 70s and the early 2000s. And they had very different drivers. The 70s was more of an inflationary era. We broke the gold standard at that time. Central banks were accumulating gold as well. And then the second gold cycle in the early 2000s was completely different. China was becoming the manufacturing plant of the global economy. They drove the commodities demand much higher. And we saw gold actually really cheap relative to equities, which is similar to now. But today we have almost like those two things combined. And, in a very weird manner, or classic manner, I should say, a lot of people are running away from gold at the wrong time, meaning producers of gold are starting to become copper producers, which is quite interesting. Production of gold itself has been falling globally, which also marked the same time when we had the 70s and the early 2000s bull market. It was also linked with the declining production of gold. Or think about what I call the trifecta of macro imbalances, which we've never seen in history, which is inflation of the 70s, debt problem of the 40s, and valuation problem of equity markets and other speculative environments. So it's hard to believe gold's not going to be breaking out, and it is at an inflection point. And I think we're very close to seeing something very special for the metal.
We've heard that a lot before, but this time it feels very different to you, Tavi. Why?
Well, it feels different for many reasons. I don't think people are starting to understand that the treasury market is not a risk-free asset necessarily, meaning you can lose money owning some of those instruments. And not only central banks have learned their lesson of perhaps even losing their reserves because of geopolitical problems, but also seeing the value of it being destructed for so long. And that's the main reason is that fixed income has been overwhelmingly used as a kind of replacing gold over the last 20 to 30 years for most portfolios. And we're starting to see the shift for different reasons. The central banks are more looking for a neutral asset. And I would say 60-40 portfolios looking for something that is not very volatile. And what else is different here is the government situation itself. I mean, the US and developed economies are facing what I call a chronic debt problem with very embedded inflationary issues. This inflation problem we're seeing now is different than what we saw back in 06, 07, leading up to the global financial crisis, or even the early 2000s. We didn't see any inflation like we see today. Deglobalization is a problem that I think we've seen in other times in history, but this is very unique and certainly intensifying. The labor shocks. I mean, how many times we're seeing labor strikes all over the world, not just in the US, all over the globe is happening, or the chronic underinvestments in natural resources, meaning just look at the aggregate capex for companies and the pressure from ESG, other policies not allowing them to produce or develop or explore natural resources. All that is adding up to this. And I think an inflationary era that we're about to face. An inflationary era just means inflation running hotter than historical standards. And that forces cost of capital higher, and people start owning more hard assets. And so to me, it's as simple as that, as what's unfolding in front of us.
Tavi, I want to go back to a point that you mentioned earlier, and that just deserves more focus. And that you said that 70% of financial advisors in the US have a 0 allocation to gold? Does that mean financial advisors that manage individuals' portfolios, or what kind of financial advisors are we talking about here? Is this across the board? Is this big funds? Is this family offices? Is this financial advisors for individuals with a certain amount of assets, or is this like across the board here?
This is a word, and by the way, if you look a little further in this chart on the far right, you can see that they asked the question, how many of them own 10% or more? And the answer was essentially 0%. That's even more important because back in the 70s or so, portfolios used to own over 10, 15, 20% of gold. And I'm not here to claim that gold should be that 40% of your portfolio or anything like that. If it fits your portfolio, great. But I don't think it should be zero. And I think it should be multiples of what it is currently. And therefore, yeah.
So Tavi, it begs the question, when these guys start to realize this or start to see demand for gold, as we just mentioned, like we saw from David Einhorn, for example, and they allocate even 1% to gold. I mean, what does that do for gold demand and for gold price, even if there's like a small allocation from such a huge number of financial advisors?
Well, that's precisely the reason why I believe investors should be focusing on the sort of cascade effect of gold entering a long-term cycle. And I've never seen a long-term cycle in gold in where silver doesn't lead the way to the upside. In fact, right now, if you think about what's happening with the metals and mining industry, it is as distressed as it can be. No one is even interested in learning about it. In fact, there's not even geologists with interest in the space, meaning we're seeing undergrads of geoscience actually declining secularly as well. So everyone wants to be a technologist, but we're forgetting about basic necessities of the world. I find it hard to believe we're going to go from affordability of housing, building more homes. We're going to go from a green revolution, restructuring electrical grids. We're going to see revamping of G7 economies, improving highways, airports, and all sorts of things. And even from a defense spending as well, which includes some metals and mining too, without seeing this industry becoming a lot more relevant relative to the global economy. Right now, for every dollar going into the global equity market, only 3 cents are going to metals and mining. So to me, it's just shocking what we're seeing. Let me just give you one more statistics that is so important. Magnificent Seven is something that a lot of people like to talk about. How about the Magnificent Two? Apple and Microsoft weight in S&P 500 is about 15%. That's more than 4 sectors combined in the S&P. That is 70 times more than the metals and mining weight in S&P 500. And we're talking about large cap. What about the small cap names and all that? So to me, it screams asymmetry and it screams as well risk reward up to the upside. And so I'm really, I'm fascinated by the fact that this is one of the oldest industries in history, offering some of the best opportunities for returns for the next decade. So I think it's time to be, very focused in the space and trying to unlock value, because there's going to be a lot of opportunities here.
Right. And again, I also want to bring it back to another statistics that you mentioned earlier and want to elaborate on that. And that you're saying that we're very similar an era now as we were in the 1970s for a number of factors, including inflation, including where we are economically speaking beyond inflation. But you mentioned that back in the 1970s, central banks had a much higher percentage allocation to gold than they do now. And that right now, I believe you said it was 80% of central banks' allocations is towards sovereign debt. And that's even with the increase in demand that we're seeing from central banks. So break that down to us. What happens when central banks go back to the allocation ratio of the 1970s, and help us understand where we were in the 1970s and where we are now?
So going back in that time, 1971 and the break of the gold standard, and we've seen fiat currencies trading more freely and so forth. And despite that, central banks were actually still accumulating gold. Well, central banks, you have to think about them as they're trying to create some sort of anchor to their monetary system's stability. And Historically, gold has served as a really great way of doing that, in which I don't believe that's going to change anytime soon. But at the end of that decade, yields across sovereign debt instruments like treasuries and European debt in some other places were yielding quite high. And therefore, those institutions began to accumulate sovereign debt instead, which was the right move. We've had this inflationary environment for many decades. So you have to pay attention when those large pools of capital begin to accumulate something at the very beginning. And that was a time when you should be paying attention to that and not being overly invested in gold. Right now, we're at the opposite of that trend, where we've had over 30 years of them basically buying sovereign debt of mostly US treasuries and other developed economies. And now we're seeing kind of the back of that curve where it's been formed a base, as you can see in this chart, where central banks have started to accumulate gold in a very large way. And I know this has sort of been the case for the last few years or so, but this is accelerating to the upside. And there's so much room. If you just think about going to the average, which is about 40% all the way back to the 70s, with the 40% we're now at 20, that's double from here. Think about that. That would take gold at least to $3,000 to $4,000 to $5,000 an ounce, easily. And so that's assuming no other institutions following up with central banks, which historically that has never happened. Every time central banks start doing something, other institutions follow along. So to me, this is it's classic setup for you to own the metal over time. And technically speaking, even with the triple top, which usually we tend to see a little bit of a decline, a little bit of a drop in price after that triple top. And right now we're just heating up to another recharge and potentially going much higher. So I get excited about all the opportunities that will be unlocked just because of that alone. And I'll remind your viewers one more time, if gold does break out, that means likely we're going to be entering another gold cycle, which is, usually a decade long of those. And I've never seen one that doesn't follow along with other commodities. And so it's really not just gold. Gold is going to be serving more of a defensive asset, but there's going to be other commodities that will kind of be linked towards to the upside along the way. And I get excited about all those opportunities because it's going to be great for investors. So you got to be paying very close attention to this right now.
You certainly sound very excited, Tavi. So let's talk about that breakout level. What is it going to take to get gold consistently above 2,000 and 2,100 and really take it into that next level? What trigger do you foresee needing to happen for that?
Yeah, I think number one, what's happening is the break of correlations we're seeing in markets. I'm old enough to remember when Japanese yen was considered a safe haven. It's been collapsing. And so there's a lot of things that used to be perceived as safe havens, treasuries, the Japanese yen, other sovereign debt as well. And all those things have been declining. Gold has been holding its value. Now, as we see the economy starting to show more issues and maybe hard landing, I think this is going to play out very different than 08. And I want to stay on record on this because I really think what we're going to see is that investors are going to flock into gold as we see the economy showing more signs of a potential for a hard landing occurring in the next 6 to 12 months. I think that we're going to see that very soon. And I think that's what's going to drive the gold prices a lot higher. It's hard to believe that gold prices will go, just slightly above that 2,000. I think it's going to be an explosive move to the upside. And silver is probably going to go a lot higher as well along the way. And to me, it just seems like the entire industry is waiting for that to occur until we see other things. And, more importantly, even from a micro perspective, think about what's happening with majors starting to engage with the smaller miners. And we're starting to see some acquisitions happen here. Even with stock prices being so low, because they still have cash in one of the best cash balances we've seen in the history of this industry. So we're starting to see some takeovers and some acquisitions, and all that to me is marking or setting the stage for a very large bull market in the miners too. So all that is kind of coming together very quickly. And I think it could happen in 3 to 6 months. Gold could be, we could be talking 3 to 6 months from now, and gold could be, at 2,500 or so. I wouldn't doubt at all.
Gold at 2,500 in 6 months' time. Tavi, help us understand how you're positioning your portfolio. So gold is going to go up, silver likely to follow, and silver is cheap relative to gold, as you're saying right now. You're clearly having zero exposure. I'm assuming, correct me if I'm wrong, to the Magnificent Seven. Are you fully out of equity markets right now, or do you have any exposure to the equity space at all? U.S. equities.
We're short some of those names. Not to name individual names, but certainly we're short a lot of those mega cap companies. I think that we've seen the growth in those businesses already in terms of I'm not sure the valuations make sense. And I think that there are other, like I mentioned, Brazil, great opportunities. In fact, Brazilian markets is actually outperforming the S&P 500 year to date. Even with the Fed raising rates as much as it has been, and even with the Fed doing quantitative tightening overall, with the balance sheet actually contracting as much as it has been, historically, we don't usually see that type of strength and resilience in Brazilian markets when you've seen central banks really tightening monetary conditions in the developed world. But that to me just shows that there's institutions really spreading their wings across the commodity markets. And commodity markets are quite small. There's not much you can do outside of the usual, and so it doesn't take a long time until you start looking at resource-rich economies that are likely to also benefit from those tangible asset prices is starting to rise. And so Brazil is certainly one of those. South America overall also looks much more attractive. I just don't see the point. I mean, yeah, sure, we can talk about the timing of all this. And we all have a view, but none of us really know when equity markets are going to turn lower. But keep in mind that this weight, the way we're seeing this dominance of market cap companies with a high market cap or mega cap businesses in the indices, it works both ways. It works very well when the markets are going up, but when it's going down, you're going to see for every dollar being sold in S&P, 15 cents are going to be sold on Apple and Microsoft. Or think about that on the triple Q, one of the most popular ETFs for NASDAQ 100. That is, those two companies are 20% of that ETF itself. So I think there's going to be more pressure on those companies as we see the kind of this unfolding of a potential of a hard landing here in the near future. And so, I don't think necessarily you need to be short if that's not your risk parameter and risk profile to be doing those things in the market. But what you could do is just avoid a bubble, avoid a speculative asset that is historically in one of the most expensive levels we've seen in history, and try to focus on things that are likely to be the next FANG stocks or the next popular idea. Investing is about people agreeing with you in the future, not today. And there's plenty of people that would agree with you if you discuss the potential for AI, but not a lot of people talking about mining or acquiring mineral claims or developing new assets in metals and mining. I get quite excited about that because it's as contrarian as it gets, and I've never seen so many macro reasons to be doing that.
Well, Tavi, just as we wrap up here, that does bring up the question of sentiment then, right? Because so much of equity markets are driven by sentiment and are divorced from fundamentals these days. I mean, price to earnings ratios are completely out of whack. Nobody's even really looking at what dividends certain companies are paying. It's mostly about expectations of future appreciation, not even future growth or future earnings. It's so much sentiment driven. So if the sentiment doesn't catch up with the contrarian view of yours, which the fundamentals may back up, but if the sentiment doesn't catch up, does it ever really then build the bull case for commodity companies and miners and gold and silver?
Look, those things, the type of extreme allocations in asset classes, they are very cyclical throughout history. And so maybe this is the first time in history we're going to see, even further period where equities and bonds are going to continue to be as heavy in terms of portfolio positions as they have been. But I highly doubt. And I think that if inflation continues to surprise people to the upside, more and more folks are going to start thinking about hard assets as an opportunity. It is shocking to me how hard assets are just folks are so skeptic about owning them in an environment like today. And if you think I'm wrong, look no further than this chart of central bank assets, ownership of gold, or also look at what's happening with 60/40 portfolios. There's the reason why they're called 60/40, and hard assets get zero allocation towards that. So to me, that's just, it's hard to believe it's going to happen. If I'm right about inflation being embedded in the system, if I'm right about the government being in deep trouble and actually forcing further dilution of capital or of money overall, debasement of currencies over time, I believe that hard assets are just going to get into a very interesting environment. And I'm not seeing, if you look at the Barron's curve cover, I'm not seeing people talk about buying hard assets. In fact, the Barron's cover recently had time to buy bonds. And cover of magazines are usually wrong. And so not too long ago, they said inflation was dead. And so, I'll take the other side of that bet all day long.
So Tavi sees a hard landing, and the way to protect against that is hard assets. Final thought, give us more information about the hard assets that you're looking at.
Well, here's a chart that I think everyone should be looking at: commodities to equity ratio. I think that this should be, it is my mantra. It is something I think about all day long. And it's something that tells you so much about history, but also tells you about the overvaluation of financial assets and how cheap commodities are, and tangible assets and hard assets today. And I think a lot of people are going to be surprised about that shift of sentiment that we talked about, that skepticism of something that's been so unloved that is likely to be loved. And the multiples, or the generational wealth opportunity for investors to be solely focused on building new mines, or not. I don't want to just pinpoint mining. I mean, it could be energy, it could be agricultural commodities, it could be all sorts of commodities, it could be uranium. But I do think that metals and mining specifically has never been so distressed and so depressed in terms of valuations. And I find it hard to believe it's going to be the case 5 to 10 years from now.
Well, you have made your case very passionately and very emphatically. Tavi, always a pleasure chatting with you. Thank you so much for joining us.
My pleasure. Thanks for having me.
All right. Thank you to Tavi Costa. And as always, thank you for watching. For me, Michelle Makori, and the rest of the Kitco team, we will see you next time. And if you are watching us on YouTube, make sure to subscribe.